Hi everyone, this is Paul Lang from Disciplined Trading Strategies, and I'm presenting to you today a video called The Market Today, Part 1, How We Got Here. This is being recorded on June 2nd, and I've been working on it for most of the prior week. Before we begin, I want to make a couple of things clear. Number one, I'm always upfront about what I say and what I do, and it would be harder for me to be otherwise because I have a lot of followers, I have subscribers, and any video I put out there, I leave up. DTS will be 5 years old this summer, and everything I've ever recorded is still out there for people to listen and view. If I ever get something wrong, I consider that a learning experience. Trading is about odds. You're not always correct. Trading, investing, I use those terms interchangeably. You can trade short-term like day trading. You can trade mid-term like swing trading, long-term investing, whatever you want to call it. Nothing makes me madder than to have people that are out there making predictions and calls and for the most part be dead wrong and then take credit for them somehow or another. Everybody seems to be a market professional after the fact, and they love to come on and tell you why something happened even though they had no idea it was going to happen and perhaps even had it very wrong themselves. Many times they had the opposite view, or perhaps they were a little early. I know people that have been calling the market a short for 6 years, and they'll probably take credit for the drop that just happened and erase all of the videos that they said and discussed more than a month before this, and they'll claim to be correct on this. That's the way this industry works sometimes. Those of you that know me know that's not how I work, and for those of you that don't know me, if you come visit the DTS site, there's a great deal of information on the free stuff page where you can learn and get a good understanding of many of the things that I teach. I'll be showing the QQQ charts throughout this. I look at the QQQ and the SPY and the IWM, which are the small caps for my longer term analysis. I look at the QQQ and the SPY every day. Generally, they kind of mirror each other. If they do mirror each other, it doesn't matter what you look at. If they don't, you need to understand there's usually a reason why they don't. Understand the reason, and then it doesn't really matter which you look at. I tend to think the QQQ tends to lead more. I generally use those for my chart analysis. It doesn't matter if you want to look at the SPY, that's perfectly fine. It's not just people on the internet, but even the so-called professionals on the financial shows. I want you to keep in mind what they really are. They're not really market professionals for the most part. Many of them are some good names, but remember they all are working for companies called CNN and Fox News and all the other networks out there that produce financial shows. And remember that that financial show has a job. It is a business, and their job is to make money. How do they make money? They make money by having a large audience. How do you keep a large audience? Well, for the most part, you tell them what they want to hear and you don't offend them. When's the last time you heard a major network news show tell you that the market was about to crash or to fall or anything like that? It's never the case. Most of the guests give you comments like this. The market has been trending higher and that should very well continue unless something steps in to affect that. If that happens, we could see a serious correction. Well, comments like that are never wrong. If the market goes higher, they're right, great. If we drop, they pick the reason why we dropped, and again, they're right. But this is worthless. You don't make a penny from this. Remember, these shows want to keep their viewers, and in order to do that, they want to keep people happy and keep them thinking bullishly because most anybody that's listening is bullish. They have a portfolio full of stocks, 401k full of stocks. They don't want to hear things are dropping. They want to be affirmed that they're correct on holding forever. The shows can get away with this because the market is up more than it's down. It's bullish more than it's bearish. And time-wise, there are much longer periods of time that we are rallying and bullish than we are falling. So if they simply keep that permeable attitude and always say everything's bullish and wonderful, that's great. You're happy with them most of the time. And when things drop, even if you lose half your portfolio, that is always going to be some unforeseeable event that nobody could have predicted, and there's no way that could have been avoided. And they go on, and then we start getting bullish again, and they keep their audience, so everybody's happy. They like to have guests on a lot that say you can't time the market, but nothing could be further from the truth. You can time the market, and usually with some great precision, even in the long term. Naturally, short term is relatively simple. We day trade by finding the tops and bottoms every day. We look to midterm investments or swing trading by finding the tops and bottoms on daily charts every week. And even the long term, for the most part, is usually very predictable if you know what to look for. However, those big turning points are not nearly as often. As you'll see in a minute, I've been bullish for 12 years in the long-term picture. There's not a lot of chart analysis to do during long bull market runs like that. But when they come to an end, it's important to understand that we're coming to an end. So this is going to be a very educational discussion. And for educational purposes, this is an after the fact discussion. I'm going to be discussing how we got here, looking at the last 2 years basically. However, this is not using after the fact analysis. Everything I tell you and discuss was discussed in real time at the time that it happened. That's an important distinction to make and to understand. I'm simply going back and explaining and educating what I've done over the last 2 years and what I relay to subscribers at DTS. DTS has publications that involve market comments, the DTS Long-Term Trader, the DTS Daily Market Letter, and the Weekly Market Summary, which is a free publication to anybody who's a member at DTS. As I go through the analysis, I'm going to be using and only using comments and discussions that were had in these letters that all happened in real time. So you can see how this is actually handled in real time, not just somebody after the fact telling you why something happened when they had no part of it. Naturally, I may add some additional educational comments, but everything I'm discussing here was actually discussed in real time to DTS subscribers, and in many cases even to the free DTS members through the weekly market summary. Now again, in being very upfront, I want to point something out, that this was the most unique time, certainly in the time I've been in the market, and I dare to say this is the most unique time in stock market history for the last century. I started in '99, and there were two larger crashes, if you want to call them that, in 2000 and 2008 that were actually very predictable. The bottoms were very predictable. Everything was pretty simple. Many people get confused looking at technical analysis and don't understand it, but it's not that hard to figure out. You can find tops and bottoms fairly easily. And by the way, even if you don't think you can, you don't need to make money. If you want to make money, and I'll show this to you shortly as we talk about last year, but if you want to make money, it understands just understanding chart patterns. You could not necessarily have tops or bottoms in the market and yet make money through the use of individual stocks. I'm talking about looking at charts here. And when I talk about charts, what I teach here applies to any type of a security you want to trade, whether it's a stock, whether it's a bond, whether it's futures, Forex, it doesn't matter. I've always liked the diversity of stocks because you have so many different things to look at, and that's what makes it possible to have a market bias that's kind of your backdrop to say we're bullish, long-term, short-term, mid-term, whatever it is, and then to try and find the stocks that best exemplify that. As you come to turning points, you start to switch your portfolio from mostly long to mostly short, try to exit the longs and time everything out. If you know how to do that, it's not that difficult. It keeps you safe in all market environments and keeps you from ever losing much money at all if things go wrong. But again, I want to emphasize, I didn't nail this one. I did well throughout this experience that really began with COVID, but it was a much more difficult time to handle, and the reason was fairly simple. We were in quite a rally if you look at the beginning of COVID. Now in this chart here, this is the monthly chart, and we had a tremendous rally after COVID. But if you back this chart up and take a look at what it looked like, you'll see a chart like that in a minute. At the time COVID hit, we were quite extended before COVID hit. And it made it very difficult. COVID was shock value news. Now that's very rare. As a matter of fact, the only time I'm aware of that there was shock value news, certainly when I've been trading in the last 20 plus years, was the 9/11 event. And that event actually came after the market had dropped quite a bit. So in a sense, 9/11 did drop the market, but actually kind of put a bottom to it as well. Shock value news means that it is news that is totally unexpected to the market, something the market never contemplated, something that was never built into the market. So all of a sudden it dropped. There's no way to predict shock value news. You can be in a spot in a chart where you say, hey, any news that happens here could have a devastating effect, but the truth of it is when a shock value news event happens, things can just drop very quickly and it's very difficult to handle it, but it's very, very rare. Most of the time, major tops are formed through exhaustion. That's what happened in 2008 and also what happened in 1999/2000. Now, what COVID did was it put a sudden drop into the market that then fairly quickly recovered, making the chart pattern a little difficult to understand because we had that shock value news in there. But what really doubled the problem was that as a result of COVID, we started printing money in an insane nature like never done before. Now, understanding how to read a chart is simply a balance of supply and demand. That's all it is. Understanding how to see the battle of the bulls against the bears across multiple time frames. That's very important to understand across multiple time frames. But for 2 years, demand became unlimited. We literally were printing money at a rate that was just completely unbelievable. And of course, a lot of that money found its way into the market. It was incredible on many days. We used to make fun of what we called the plunge protection team. The PPT would come in anytime the market tried to drop, boom, it would just get bought and rally into the close all the time. Unlimited money, there was no balancing act. It was just pure demand all over the place, and that's what happened for the better part of 2 years since COVID. I also want you to understand about me, I'm not a perma bear, I'm not a perma bull. Naturally, the market is historically up more than it's down, and time-wise, it's in uptrends more than in downtrends. I read charts and I do what's appropriate for the environment. I use a market bias as a backstop to what I do, and I try to find those unique chart patterns for individual stocks to make money on the way up and on the way down, both. However, just because we're in uptrends more than in downtrends, it makes no sense to be permanently bullish and just sit and watch. As a matter of fact, you can make more money on the way down because things drop faster. And it also is important to understand if you need to or want to or can sell long-term positions. If you started in the wrong moment in the year 2000 and you put your money into the market thinking that was the greatest bull market ever and was going to continue, it took you 17 years to get your money back. That's not acceptable. It's not acceptable to lose less money in a bear market. You don't lose money at all. You should be making money. If you have certain positions you can't sell for obvious reasons, you should balance that out with short positions or puts on the market or whatever it is. But you don't just sit there and watch your money get taken down by 25, 30, 50, 60, 70% and just say, well, that's what the market is. The last educational video I did on the market was back at the end of 2019, explaining how I saw and shorted the midterm down move at the end of 2019. It's a very educational one. It's still out there. It's called Bookmark on the Market 19-0814, still on the site. And before that, I had done a couple similar videos. Why have I not done one since then? Well, because we have simply been in a pure, outstanding, pure uptrend. There's the chart, right? This is where we were. 19, there's that area I shorted, and then of course went bullish again, and since then we've been just skyrocketing higher. I was bullish for 12 straight years, and let's go through how that began to change. Everything must be looked at in terms of 3 different time frames. There's your long-term outlook. This is looking out months to years. Again, 12 years I had a bullish outlook beginning toward the beginning of 2009 when we hit bottom after the 2008 crash. It was a very easy bottom to find. I said that we were going to have a decade-long bull market very likely. It went on for 11 to 12 years. Nothing changed, and my long-term view was permanently bullish that entire time until just recently. I'm going to show you when I changed it. Midterm can vary a bit, but it takes the next few weeks, the next few months, depending upon the long-term outlook and the type of move that might be coming. So midterm is that kind of intermediate. It's like when I shorted the end of 2019. That was done because at the time of that last video, October 1st to October 2nd, I went from a bullish midterm outlook to a very bearish midterm outlook. But note, the long-term outlook still stayed the same. In other words, this is a 2 to 3 month drop coming, multiple week drop, whatever it is, take advantage of it. But if you have those long-term positions, you hang on to them because it's not a long-term crash. It's just a little pullback or correction. And the intraday analysis, of course, is only for day trading. That can change every day and even changes during the trading day. It's not relevant for this discussion. But anything that I post, these are the time frames that are always being rated. Also notice that there's not only the rating. For example, this is middle of the road here would be yellow, would be neutral, kind of bearish here, kind of bullish here. That's the actual market rating. But notice below that there's a tradability rating. What does that mean exactly? Well, when we got to a point, let's say, going back maybe a year, we're still in uptrends. We're still bullish. You can't start shorting the market or playing short necessarily. But would you say it's time to take and dump a bunch of money into the market or maybe start telling younger people the dollar cost average in a year ago? We're still bullish, but the tradability got reduced to 0 at some point because you can be bullish but say, well, we're in uptrends, but you know what? It's not the good entry point. Making money requires not only knowing the trend you're in, but getting good entries so you can make money. You don't just pile into the end of a bull market because we're in an uptrend with all of your money. That's how people lose and get stuck. So the market rating is important, but that tradability rating can be just as important because it kind of tells you when to act. This is the QQQ, beginning basically with the COVID crash. When you see that crash, it doesn't look like much of a crash anymore. And I've identified 3 points in here where I took some action or at least made changes as to what was going on. Number 1, right here, toward the end of June, long-term market rating goes to 1, but so does the tradability. This is the first time I changed this in 11 years. That's the time I changed it. But note, even though I moved to a bearish bias here, also the tradability being zero means you just kind of sit and watch and wait and see what happens. The reason that was done at that time, again, was part of the COVID confusion. This is on that retest of COVID, that high. This is the high before COVID. We fell, kind of retested that high. Right in here, I thought in these red bars we may top out in there. So I went to a more bearish outlook, took away the 11 plus year long-term bullish outlook. That's all that happened at that moment. And while you may say, boy, we had some rally after that, I want to make 2 points. Number one is that at the time that happened, that's what the chart looked like. It was right there. So if you go back here, we're seeing what happened after COVID. But at the time it was happening, that's what the chart looked like. And we were up there pretty well. And that's the end of a 10 to 11 year rally. So that's when I move this down to bearish long-term, but zero tradability comments. Another point I want to make is what really matters is making money. And I'll show you, even though I went to a bearish bias, I use that as a backdrop. And my trading still continues to revolve around both long and short in the appropriate areas. And I'll show you in a minute that even though the market went up during that period of time, I was still making money even on the short positions. So that's number one. Number two then was right in here. And that's when I notched up the tradability of the long-term pattern. This is why I started looking more short. Here's what's very important to me is that when we got to this area here at 2, by moving up this tradability to the middle of the range, it meant that we now start to look at any midterm top as being a possible long-term top. What's important and something I relate a lot to the subscribers is that many times in a bear market when you begin to drop, it happens very quickly. And all the time people get stuck holding their longs, not having shorts, and we drop so much so fast before they realize what's going on and they're a deer in the headlights. So every time we have a midterm top, I react to it. So in other words, as we run through here in the long-term portfolio, I'm taking profits on the long positions and then adding in a short or two as we begin to move down like this. And these shorts often make money even if the market does not continue to drop. So we're shorting and then we're going long, exiting shorts, maybe shorting here, going long. And I'm not talking about the market, I'm talking about individual stocks. And sometimes you may short a stock here, and even though the market continues higher, the stock drops. It happens with many of the things that I do. So that's very important to understand that, and that's what the rating at number 2 meant, that it's time to start taking a poke at some of those tops in here with stock shorts, and that's what happened. Time-wise, this was not the market top yet, of course. But from a chart point of view, we just had kind of this little pop in here. And this is the third area, of course, where I really want to talk about. This again is why I emphasize this is not a perfect top. I discussed in one of the prior videos about the market, the one from a couple of years ago, I discussed the 3 ways that markets make tops. And I'm not going to review them all again. But what happened recently, this last 6 months, is the most difficult type of top because you just kind of roll over. And that's why I wanted to make this educational video to show you how I found this top and how well it all played out. So number 2, we kick up the rating a little bit right in here and look at doing some shorts even in the long-term account as we get to these tops throughout here. And to prove my point, because what really matters is how you use this information. And during 2021, which is this year right through here, it was just in January of 21 when I increased this tradability of the bearish positions a little bit. Throughout this year, I want you to notice that the long-term trader, the long-term letter that I put out, here's the stats for the closed trades in 2021. And I actually had half short positions because every time we hit a weekly top, I was shorting. Every time we'd hit a weekly bottom, I was going long. And not every time, you know, there's not a whole lot of trades in there, but I mean, conceptually, that's what I'm doing. So I ended up with throughout the year with almost equal number of shorts and longs. But I want you to notice the shorts made money. Not as much as the longs, but the shorts made money. And there's another benefit to that. Having those short positions in your back pocket, if all of a sudden we wake up one day and something happens where the market just boom, puts in one of those huge red bars, guess what? I have shorts on board and I'm already in gear, not being a deer in the headlights, so to speak. I think when you look at how it played out and understanding how you take positions, 2021 was really a great year. But what really came into focus then was that third spot up there, because number 3, right up here, number 3 is where I really turned up the heat on being bearish, and there were several reasons, and that's really the heart of this discussion that I want to get to. What you look for in number 3 and why I went to being much more bearish. In number 3, I moved the tradability up to 7. It's actually where it still is. I could have moved it up, but it's kind of a senseless number to go from 7 to 9 or 10. I just never changed it. But this is pretty much now time to be max bearish. And notice that we are still technically in a weekly uptrend at the time that I did that. And this is where I make a big deal about really understanding the language of charts. So many people just have a very simple understanding and perception of things, and they'd say, oh, we're in an uptrend. Why would you start doing that there? Well, I want to run through some of those things with you so that you can better understand exactly what it is. I also want to point out some of what I'm talking about is fairly high level here. You don't need to understand all this to make money. I have people that say to me, Paul, I could never understand as much as you do. I say to them, you know what? You want to make money day trading. You want to make money managing your own account. You don't have to know a fraction of what I'm teaching you. You just have to understand chart patterns, have some discipline, take the right stocks, and you're going to understand how to do this to make money all the time. But for this particular setup here, there's a lot of interesting things that happen. So let's take a look. At the time I kicked up the tradability to a 7, that was in November of 2021, right at the end and right in this pocket right in here. So that's what we want to take a look at. I want to examine 4 different things about why 3 was so critical. Number 1, the daily power trend leading into 3, the weekly red bars, the size, and the fact that they were not ignored. The rarely used VIX, that's a volatility index, and then also the sectors lost their rotation. Let's take a look at all 4 of those real quickly. That's the area we're focusing on right there in that red square. Number 1, if we take that red square there on the weekly chart, this is the daily chart inside of that area approximately. That goes from October of 2021 through January of 2022. First of all, this last rally leading into here is what I call a power trend on the daily chart. Now what a power trend is, it means that you're in an uptrend, you're heading up, but the bars are so tight and precise that you don't even really see dips or rallies. You're just every day you're grinding higher, very tight patterns like that. Notice like on the way down here, we had drops and we had rallies and we had drops and we had rallies, but we wanted that power trend on the way up. It was very, very tight. Now, the key thing about a power trend is it's a very powerful move, but on the other hand, when it comes very late in a cycle, what's happening is people are not taking profits. In other words, whenever you see a market move up, typically you see things run up and then there's profit taking. In other words, some of the people in this move up want to sell some of their shares, things pull back, but if you're still on a bullish chart in a bullish position, eventually the buyer should take over again and rally things, and then profit taking comes in. People who made money on the way up take some of their profits, some of the people, you have a little pullback. That's the difference. When you run into an area, however, where you're getting selling from outside the chart for various reasons, that's when it's not a pullback anymore. That's when you have outright selling and things drop more. But when you have a power trend like this, nobody's taking profits. So what happens is people from down here are locked into profits and they get mad when they don't take them initially. So when you get that first move down, a couple of red bars, we get this little retest up here. So number 1, the fact we ran into this area after all this time up and this power trend. And then number 2, you kind of see the effect of that power trend, because when we try to make that new high, look what happened. Everybody who didn't get out on this drop all of a sudden says, hey, get me out of here. And we get the selling come in. And notice then that we never recover. I want you to notice on the daily chart, and then we're going to look at the weekly chart as well, that all of a sudden we have big red bars on the scene that have not been here for a long, long time. That means it's heavier duty selling. More people selling more positions, or big boys starting to sell at these highs. When you see new highs get sold like this, that's one of the indicators. Notice all of a sudden we have these big red bars, and elsewhere in the chart the red bars happen and then they get ignored. In other words, we trade above them right away because it's just a little one-day profit taking thing. Notice here, big red bars, and they hold, they stick. We're not able to get back above them again. So the power trend all by itself, not necessarily a big deal, but coming at the end of the extended move that we had going into the end of 2021, and then seeing this chart being reacted by seeing some real selling coming in, because this now becomes not just profit-taking selling, this becomes people selling new highs. Couple that with the fact that inside that box, you're now seeing big red bars that we haven't seen on the chart before, and those big red bars are dominating. Every time we rally, we're seeing those rallies get sold into. So this is the area right in here. And actually, I did it very early in November, went to that stronger bearish rating. It proved to be the exact right moment. Back to the weekly chart, take a look at how these red bars appear on the weekly chart now. Again, notice on this way up, the tight pattern. Almost kind of a power trend many times on the weekly chart. When we do have red bars, they're happening coming off of very extended moves. Notice where we are. If you just draw some lines here, and again, there's no real meaning to these lines. That's a 20-period moving average there, not a big deal. But just notice when you get to the top of that little area up in there, then you get some red, and that's normal because you're going from the top of the quote-unquote channel to the bottom. I don't like that word. And that's perfectly fine. But when you get here, then you rally again. Red bars, rally, rally. Along the way, red bar here, totally ignored, red bar ignored. And then all of a sudden we get to here, and here's our last pullback. Perfectly normal. We're up here at the top of this little channel through here. Perfectly normal to come back to the bottom. And here's where our problem starts, right up in here. We get this next rally, and all of a sudden, look at the red bars that come in here. You've never seen a pattern like this anywhere for the prior, year and a half. All the way through here. Doesn't exist. This is that sign, that little subtle sign, that bigger money is stepping in. Bigger money needs to start selling into rallies because they have such huge positions, they cannot try to exit on the way down. So they have to sell into rallies. That's why you frequently hear people encouraging you to be bullish at the moment that they're selling because they need the public to come in and buy to offset their selling. So you see that selling happening in there. So that's number 2. Number 3 is what I titled the rarely used VIX. The VIX is the volatility index. And actually on these charts here, I'm using the VXX. It's a derivative of the VIX. It's for all practical purposes the same thing. I just don't get the VIX on the platform that I use to capture my charts. This here again is not after the fact analysis. This went out to subscribers of the long-term trader on 10/17/21. That was pretty early at the beginning of this drop in the market. It was sent to subscribers on 10/20/21, subscribers of the daily market letter. So it went to both letter subscribers. You can read all this. I'm not going to read this for you. It continues over a total of 3 pages here. I'll go back to the first page and slowly scroll through them. I just want to talk about it a little bit. You can pause and read everything that was written there back in 10/17/21. The VIX is one of those very overused things by a lot of people. It's called the VIX, the VIX. And it's embarrassing the way a lot of people use it. Number one, the VIX is not used for day trading. People use it for day trading sometimes. It's silly to do that. There's no effect on the VIX. People say that you can easily understand the market moves by understanding the VIX moves opposite of the market. Well, that's another silly comment. Knowing it trades the opposite of the market doesn't help you. Why don't you say, I'll trade the VIX by doing the opposite of what the QQQ or the SPY does? It's a silly comment. The VIX, being the volatility index, is supposed to be what they call the measure of fear. You can read exactly what it is in writing there. But basically, when the market goes up, fear drops and the volatility index goes down. And when we have sharp drops, fear goes up, the volatility index rises. What I want you to understand, I'm going to go to the next page so you can keep reading this if you want to. What I want you to understand is that the normal happening event is when the market rallies, the VIX drops. And when the market drops, the VIX rallies. That's normal. To sit here and say that, oh, I'm bearish or bullish because that's happening is just silly. What you need to look for is when something different happens, when the normal is not happening. And that's what was pointed out here the first time. And I don't look at the VIX every day at all. I just look at it weekly, and specifically if I'm looking for a market top or bottom. Last time we had a market top, when I did this presentation 2 years ago, the VIX wasn't even used. It wasn't relevant. And many times it's not. It's just they're doing the opposite of what the market does. But this time it was. And specifically what had happened was, you see these lines are drawn through the QQQ pivot lows, the lows of every little drop. And correspondingly then, when the QQQ makes that low, the VIX should make a high. So we drop, the VIX makes that pop. Notice here we drop, we make a higher low, the VIX makes a slightly lower high. That all makes sense. Then we drop a lot. The QQQ makes a very significant lower pivot low below the last 2 pivots, which means the VIX right here should have had a significant pop above these 2 highs, way up in here somewhere, corresponding with this possibly. And notice what it does. It barely pops at all, a one-day pop, and then rolls over and immediately plummets to lows before the market even really recovers back to where it was. That is what complacency is. Part of it is reflected by the fact that nobody went out and bought puts on the market to protect what they had. Nobody cared. We just assume we're going up forever. Complacency is one of the primary uses for the VIX, and this is a great example of it. Now, it doesn't mean you're going to drop right then. What it means is that people are getting stupid. And it means that the next rally may be your next rally. And that's explained in here. And again, I want you to understand this is all written back on 10/20 of 21. Turned out to be a key thing because that next rally that happened ended up being, the last one. This is a factor in me thinking to treat this rally as a long-term short. So that was written back then. It was part of the thinking to get more bearish back in November, December of last year. And I want to add one other thing about the VIX that to me is just something that people should almost go to jail for, except it's not a crime. I put on the news, both financial and local and political, just because I'm a human being and I want to listen to the news for just a few minutes every day. As much as I can take is a few minutes. So I'll have the financials on typically in the morning as I'm getting ready for the day. I try not to listen much, and I only do just so I know kind of what's going on. I want you to again understand that people on there either don't know what they're saying or have to toe the line in terms of what to say based on what the parent company is telling them to say. The comments, I heard 2 different comments in the same week about the VIX. People who don't know how to use it telling you what it means. Remember that they always have to be bullish. So the first comment I heard early part of the week was that we had just fallen. This was recently. So it was somewhere, if you look at the chart, it was somewhere through this decline through here. So things were getting really bearish. And the commentators are starting to wonder, wow, what's going on? Maybe this isn't a pullback type of thing. So on the first particular day early in the week, the market had been dropping hard, but we rallied one day. It was one of those comeback rallies. And of course, they're all happy and elated on the financial shows when we rally because everybody's bullish and wants to be bullish. And one of the things that was said, and no, I don't want to go into who or which station, it doesn't matter, they're all pretty much the same. But one of the things that was said was that the VIX dropped today when the market rallied, which shows once again there's no fear in the market and things should be heading higher again. What a stupid understanding of the VIX. That's just simply not true. Stocks go higher, the VIX goes lower. It's an inverse relationship. That's always going to happen. It doesn't mean that this is any kind of a bottom. And ironically, even if you think they know what they're talking about, a few days later, the market dropped hard again, of course, proving them wrong the first time. But now they said that when the market dropped hard, the VIX spiked. And that spike often means capitulation, and this could very well be the bottom. And then they start having a discussion. Is this the capitulation bottom in the market? There's no indication at all that it was a capitulation bottom. We're just starting. So you have to really be careful what you listen to. And if you want to learn how to do this for yourself, learn how to do it for yourself. Come see me, learn on your own, whatever you want to do. But you're not going to make money listening to other people. Now, they get away with it, like I said, because they're bullish all the time. And if you stay bullish all the time, you'll be happy a good part of your life. You're going to be really sad for a year every once in a while. By the way, we had quite a bullish run there, 11 to 12 years. That's a long time. And people in general have grown quite complacent. But if you think it's going to be easy this next upcoming year, you're going to be sadly mistaken. It's going to be one of the most difficult times in the market. And there are so many people that after the crash of 01 that just went broke, either because they hung on to stuff or because they tried buying quote-unquote pullbacks. Same thing happened in 09. A lot of people got really hurt not understanding just the most basic concepts of the stock market, chart reading, and the difference between buying pullbacks and buying downtrends. The final thing was the lack of sector rotation. Back in the last presentation I did 2 years ago, the last bookmark on the market, which you can still access, I talked about sector rotation because that was a huge thing for me back then, what happened. It wasn't quite as big of a deal here. We had a little more difficulty because a lot of money was going into oil and energy stocks, but all the other sectors, what we had, you can see it here in the XRT, the retail stocks. We had this pop that got sold into. Every time we start to see these pop, these new highs, boom, sold into, sold into. So what you're seeing with sector rotation is when money comes out of one sector, it should pop into another sector. In other words, sectors kind of go on their own page sometimes, and when one's rallying, one's pulling back because money's coming out of one, going into the other, things are bouncing around, and all of a sudden you see selling come in, but the money doesn't show up somewhere else. So I don't want to go into that anymore here. It was discussed more in the last one. You can go back and hear that one if you want to, the last bookmark on the market. So there's the 4 key points, and along the way throughout this time, starting in November of 21, these were comments. Now these first comments here are coming from the daily market letter. That's a letter that goes out to subscribers every morning. It's a quick little 1-page hit market comments for the day, swing watch list, different things that are on there. You can look into it if you want to. But the point of it was the market comments. Here are the things that were said. 11/11 of 21, midterm rating changed to max bearish. Comment, even though the bulls have been relentless, this chart pattern says we will be selling. Again, I want to point out the understanding of reading a chart. Next comment, on January 6th, note that the midterm bias has remained bearish for a long time now. We have been sideways on the daily chart, and naturally short term there have been bullish and bearish weeks as we shot back and forth. And this is that sideways pattern we had there at the end of 21, beginning of 22. If you reach that 380 area, it will mean 6 trips up and down in the sideways pattern between approximately 380 and 405. Knowing this is the likely pattern is very helpful, as it keeps you from going long in the long term where it appears to be a breakout. In other words, if you look right here, a lot of people could consider that a breakout above the prior highs. Understanding the pattern, understanding exactly what it is, you know we're not going anywhere, you know it's going to roll over and go shorter. It's not relevant that you traded slightly above these prior highs here. 110. At times, I've had that line to a dotted line, meaning the expectation is for it to break. Now, when I do these charts, a dotted line means it's not really support. A lot of people look at this chart and say it's support, but a lot of people don't know what support or resistance are for that matter. Solid red lines, solid green lines are what I use to represent real support or resistance, something that should hold. Now, naturally, a lot of prior focal areas, such as what you see here, may have a temporary bounce. They may be effective, they may be areas that people look to, but they're not really going to hold. And note that this was said ahead of time. As you came down to here, it was said, this is probably not going to hold. So today we'll be testing that support area, which means either the market holds a sideways daily pattern or begins falling and possibly challenging the uptrend that has been in for 18 months on the weekly chart. So this was this sideways pattern that came after that long uptrend. And then you see it is 10 days later. Look what happens. Note also, I mentioned repeatedly that the low from last Monday was not going to be support, and that's back here. We blew through it without any hesitation yesterday. So we just blew through this area here, and that, of course, began the breakdown that you see on the charts today. So we just blew through that area right there, and of course, that was the first move down that really disrupted what had been a long-term uptrend and then sideways pattern throughout the end of last year, beginning of this year. Here's how that looks then on the weekly chart. You can see right there, that is that breakdown area we just discussed right here. That area right there is right there on the weekly chart, just here staying coordinated. So we had been in a long-term weekly uptrend here. I recognize this in the middle of this as being the top and was short and short ready all up in here. We then broke down, we actually broke the uptrend. Now there's a lot of terms you can throw in here depending upon how you like to talk. You're in an uptrend, you challenge the uptrend, you break the uptrend, you're now in a tentative downtrend, you're now officially in a downtrend. Again, that all depends on what definitions you want to use for everything. What matters is what do you do with that information? How do you trade it? How do you make money from it? So at this point here, in my language, we had broken that uptrend, and I felt this would stay broken. And of course, you can see from here, from this point on, it just gets to be routine. We rally back. Of course, now what's happening is when you get into a true downtrend like we are now, as you rally back in here, what's happening is all these people up in here that said, hey, we've been in an uptrend forever, I'm hanging on, all of a sudden they're in a lot of pain, especially if you went long up in here, up in here, up in here. These people are in a lot of pain. So when we rally back, they say, okay, I'm out of here, that was a mistake. And that continues to happen. And that's what a downtrend is. People sell, and then prices get so low they say, I'm not going to sell my longs anymore down here. Or people who shorted are taking profits, and we rally back a little bit, and then you get hit again. And that is where we are right now at this moment, at the time I'm saying this. As of June 2nd, I want to add the comment that this upcoming period of time is going to be extremely difficult. I felt as of last Monday, that'd be going back to the last week in May, I said in all my publications that we're going to get a bounce here, probably a significant bounce of some kind. It's going to be difficult, wild, and sloppy for a period of time now. And finally, I just want to point out that even in the weekly market summary, which is a free publication that goes out over the weekend to free DTS members, it's supposed to be just a little summary of what happened the last week and then what to look forward next week in terms of earnings and econ and that type of thing. But even there, you can read the comments. I'm not going to go through, but you can see even in there, I couldn't help but to give some very good hints as to what's going on in terms of the fact that market trends may be ending and to be careful. I also might try and make sure people are safe. If you're somebody who's out doing it on your own, well, you're doing it on your own. You got to live through those consequences. But I always want to try and make some comments when I can to try and keep people on the safe side of things. Even if you don't get the top, don't get hurt on the way down, so to speak. More comments, 123, while we broke weekly uptrends, we're not in downtrends yet, and that's back on 123. If you're on your own, make sure you know what you're doing, and you know the difference between a market correction and a free fall. Many traders have lost fortunes buying dips that are not dips, and this was the comic that was featured that week. I think some of these are kind of funny. Oh yeah, well, I'm calling the Fed, and that's a pretty accurate indication of exactly what's been going on over the last 2 years. I want to add one other comment when you really get an understanding of the market, of how it works and kind of the psychology behind it, that once the market gets in a little bit of trouble, trying to help the market is very resented by the market because it provokes fear. If all of a sudden market participants think that people, the government, whoever, are trying to help the market in some way, well, that makes them think, well, if the market needs help, that means it's in trouble. So I made a comment before the Fed meeting on February 6th, just kind of a fun comment. I said, regarding the usefulness of news, here's a prediction for you. If the Fed makes an announcement that they are backing off interest rate hikes, something the news people tell me the market would love because it hates interest rates being raised, the market will fall hard shortly after that. I almost guarantee it, well, as much as you can guarantee anything in trading. That was a comment in one of the publications that went out. What happened was that the FOMC did make a very bullish announcement, quote unquote bullish, very market friendly announcement. It said that there would be no 3 basis point hike coming, something that the market was very worried about. The market celebrated immediately when that was stated. The market rallied immediately upon that news and stayed strong the whole rest of the day. That's the Fed day, that green bar. However, look what happened. The next day, oops, the next day, oops. Maybe we don't like that comment so much. So you can just kind of get a sense sometimes of what's going on and when things are turning. And the last point I want to make, I showed you some stats from 2021 where even though I was transitioning to a bearish bias, I continued to trade both sides, bullishly and bearishly, and made money both long and short. And the bottom line is, what do you do with this information? What good is it to know where the market's going? Well, if you only trade the market, I think that's a hard job to do. You have to do the best you can trying to get the tops and bottoms in markets. But here's what I do is I use that market as a backdrop and then trade stocks. And many of you who know me probably know this already. 2021 was a pretty good year. You can read the results there, how they're found. And at the time of writing this, the last update, 520 about it, well, I put that in here when I was doing this. It's about a week old now. We're slightly under that right now. But what I always said to people was when the market drops, I'm still going to be making money. It doesn't matter to me if we're up or down. And this is the proof of it. This year, the market is down. The QQQ is down 22% today as I'm speaking, something like that, and still making money. I'm not going to go through all the trades. I've done that in presentations for the subscribers, the long-term trader, and also to the DTS seminar program members. But you kind of get the idea from what I'm saying here. Understand charts, understand what you're doing. It's not really that difficult. A lot of it is actually kind of common sense once you understand how to read a chart. I hope you enjoyed this presentation, and as it implies, part 2 will be coming. Where are we going? Now, don't get all excited about this. I don't know when it's coming, and don't look forward to this in terms of being your indication of what's going on. These little educational things are not to be your market guidance. The comments I give in part 2 are not going to be specific as to when what's going to happen. It's just a big, general, broad look as to what's going to happen because I have a very firm view, almost with certainty, where we're going to be going. So I'll be working on that over the next month or so. Don't be sitting here waiting for it. Again, it's going to be an educational event. Those people who subscribe to the DTS services, you'll be, of course, hearing the blow-by-blow every day and every week as things go by. Interesting time in the market this last couple of years, I think unique to the whole entire century. I hope you're all doing well, however you handle the market. I do want to remind you that if you have long-term investments, nobody can manage them better than yourselves. Remember that the mutual funds lag the market on the way up, and they try to not lose as much money on the market as the way down. That's a fact done by an S&P study that 94% of mutual funds do not beat the market. You can learn it for yourself. You can learn to do better. And if you have any time free during the day, make a little extra income day trading. Until the next event or the next time you hear me, this is Paul from DTS. Good trading, everybody.